Welcome to the Multifamily 0 to 1 online meetup, where we discuss the best strategies to get started in apartment syndication.
Thanks everybody for joining. So for those who are here for the first time, we appreciate you joining us. We meet the first and third Wednesday of every month. So this edition, we're focusing on the passive investors. Before we get started, I just want to remind everyone that this is an educational presentation and we're not making any investment recommendation. You should always consult with your CPA and attorney for financial and legal advice. My name is Marcelo Cazini, and my background is in IT and project management. I am a multifamily investor. I own my own commercial real estate, and I also was involved in single-family fix and flips, and I'm also a member of CCIM, and I've completed all of their designation trainings right now. And Claudia and Martin, if you want to introduce yourselves.
Yeah, this is Claudia Rubio. I'm a full-time real estate professional, and I also have a degree in architecture, and I've been managing my assets in Colombia, where I was born, South America. So I still manage some assets, but I've been managing all types of assets for the last 25 years. And now I'm doing multifamily full-time here in the US.
I'm Marcelo Rubio, and I do whatever she tells me to do. I'm an IT security consultant. I've been an IT security consultant for over 25 years. But all my life, I've always been related to real estate in some way or another, from my family before, and then with Claudia. We've been together for almost 14 years, and in those 14 years, I've learned a lot from her on real estate. And we wanted to start this adventure on real estate here in the US a year and a half ago. And so far we've invested passively in almost 500 units. And we are currently syndicating our first deal.
All right, perfect. Ryan, do you want to introduce yourself?
Yeah, for sure. So I grew up in the East Coast, did my undergrad at Georgetown, did my MBA at NYU, and then had a degree in finance. And so the natural progression was to start working on Wall Street, and started in oil and gas derivative sales. So basically, how I kind of explain that to real estate folks is when you lock in your interest rates on the real estate side. I did that, but for oil and gas, so commodities. And moved to Houston about midway through that time, just to be closer to clients, and also just have a better work-life balance instead of being on the plane all the time or having a crazy commute from the suburbs of New York City. So in terms of the multifamily side, for many years, just given the cyclicality in oil and gas, was looking to do something that had more sustainability and growth to it, and started learning about the multifamily space, and just thought it checked a lot of the right boxes for me, and was easy to transfer my skills, and I also had a tax sheltering opportunity this year that I wanted to square away, and so decided to just devote my time to investing, syndicating, and investing in multifamily. So actually passively invested. I'm going to do another one, so that'll bring me over to 2,000 doors, Texas, Florida, Ohio, and Arizona. And then of course sponsor 2 deals. All
right, excellent. So Ryan, we have a few questions that we have prepared to kind of just keep the conversation going. But for everybody here, this is really meant to be interactive and help us all learn, be better investors. So as you have questions, feel free to ask them, or if you don't feel comfortable asking, there is on the bottom of the screen there, you can see a chat. And you can post a message, and then we can, one of us will ask the question. So with that, I think, Claudia, you were going to start, right?
Yeah, Ryan, so was multifamily your first step when you started investing in real estate, or did you do something else related to real estate before?
Yeah, no, that's it was multifamily. I own a house here in Houston, and so just did not want to buy any more single family homes in Houston for just thought it's the same risk and exposure. And given from a portfolio perspective, this house is a sizable portion of my overall whether net worth or investment portfolio, and so decided that multifamily in different markets and in different submarkets and with different sponsors was would bring me more diversification than just buying single family homes.
And how did you get to know about multifamily? How did you find out?
It's there's one of the kids that goes to my child's school who's my son's 8. His friend's dad and I were at a Chuck E. Cheese of all places at a like a 8-year-old birthday party, 7-year-old birthday party, and he was telling me that that he had gotten out of all his single family investments and was transitioning to multifamily. And I was like, oh, tell me about it. And I always thought, large names like Blackstone or some other private equity groups own multifamily buildings. And then when I found out it was really, syndicators like ourselves, then it was like, wow, I think this is something I could do. And what was interesting, he just said, there's a meetup that's coming next week. You should go to it. And so I went to it and just connected with a number of people and kind of, that just started the run. But, for many years I'd been looking for something different. And it's just, when you find the thing that you're looking for, you just, go all in.
And as a passive investor, what was the most attractive thing for you?
The taxes. So I knew that, I had a fair amount of income I needed to shelter this year. And so that was really attractive. And I just like the story of, assets that are high occupancy, that demographics were becoming initial renters, that, people renting is just, we own a fairly sizable house here. And I just feel, when you go to some of these, apartment complexes, particularly the nicer ones, they have tons of amenities and, life is so much easier than, a water leak in your house or, this, the smoke detector is going off in the middle of the night, whatever it is, it's just easy to just pick up the phone and call somebody. So I think just seeing that, in the trends from millennials, from baby boomers and so forth, just, in my mind made a lot of sense to start investing in the asset class.
Good.
Yeah, that's great. And so you mentioned that you had this conversation, you went to a meetup, and then did you feel like, hey, before I do my first investment, did you feel like you had to get any sort of education, or walk us through the process of what it took for you to feel comfortable to make a first investment from an education perspective?
Yeah, for sure. So I looked at, the first investment, I looked at a deck, and just try to figure out, okay, what are the questions, what are the pain points, and just for this particular sponsor, just asked them a lot of questions. They sent their underwriting over, and then just started, tooling with the model and figuring out, what cells were driving value and so forth. And a large part of it, I wanted to move pretty quickly, because I think, generally, sometimes it's easy to just kind of rest in a state of inertia, just inactivity. And sometimes it's hard to just take that first step. And I think that's kind of why you've created this podcast or webinar for other people to, encourage them to move forward. And I just felt like if I went to a meetup or, had conversations with people, whether property managers or other people, just be a lot better of a story if I said, hey, I've already invested. I like the asset class and so forth. So for me, I knew I wanted to move quickly, and then it became, what sponsors are out there that, will take the time to answer the questions thoroughly that I have. And, kind of hold my hand a little bit through that first investment in terms of understanding, all the pain points of the investment. And so there was one gentleman that did that. And so I said, hey, I'll invest here. And then like each time just got, smarter with, the questions to ask in the submarkets. And so it just became easier each time.
Got it. And you mentioned a few markets that you're investing. So what market was that first deal?
It was in DFW.
All right, cool. So let's say when you started that process from the first meetup until you found that first deal that you decided to invest passively in, how long did it take you?
Like a week. Yeah, I think it was real quick. It was real quick.
Okay.
It was really, really quick. Just because I haven't, a finance degree, and I've looked at, a lot of opportunities and things, and so it was pretty quick.
Okay.
It was pretty quick.
Okay. Okay. Do you have any information that you want to tell us from that first deal? Like, maybe, I don't know if you want to talk about the sponsors or not, location, number of units, class, demographics, anything that you think would be relevant?
It was, I guess the relevant thing is that I'm getting my first distribution on Friday. So that's good. from that deal. So it's, it actually,
that's awesome.
Yeah. So that's exciting, right? That you start seeing, because like you put in a lot. I invested a fair amount of money this year, and so it's nice to see some of that come back. And I've already seen some distributions from some of my investments, but from that very first one, which is this deal, that getting that on Friday, so that's great. I think honestly, I would say I invest purposely passive. So in this particular case, my purpose was, the goal was to get invested, quickly, so that you could have, people would take you more seriously. Like, because if I just said I was calling on different people and they're like, well, what's your multifamily experience? And I said 0, it would be hard for them to take me seriously versus, hey, I've already invested. I'm looking at other opportunities. I'd love to chat with you. I think that narrative was just a lot stronger. So, purpose there was to move quickly. 2 was to find people. For me, a lot of it, whether it's just a God-given ability, I find that, when I meet people, I get a good sense of whether, we could work together, whether they're, I find them trustworthy, and, I think, vice versa. So here, when I started talking with that group, it was a group that I felt that, these guys seem pretty trustworthy, and particularly their response time and answering questions. I come from, a profession where, responsiveness and professionalism is really, really important. And, they were super, super responsive, and took time on the phone, on email, just answer a lot of questions for a pretty small investment. So that helped. I think the other thing, in terms of purposely passive, is when I was looking at the model, they were cutting expenses, and it was a rougher area in DFW, and they were saying that they're going to cut security, and I'm like, wow, that's really interesting. Like, this is a rough area. And, one guy flat out told me, like, don't invest in this deal. I've been to that area. I was looking at it. It's horrible. And then, I started looking around at, the path of progress story. And I said, you know what? I do want to invest to see how this works out. So there was this purpose of, what is it like to invest in areas that, from a median income standpoint, or from a price per door, are just tougher, or when people say it's a rougher area. But if you're buying it at a good basis, it gives you an opportunity, even if you have, whether higher economic vacancy or bad debt or so forth, you can still, perform well. So, that was kind of the purpose, is to see how is this thing going to perform. I think you invested in that deal too. So I think when we first met, we sat down, Martine and Claudia, you had said, hey, we're in that deal. So that gave me comfort. At least I picked, a good horse. So. But I think a lot of it for me is taking bets on sponsors. I think that's 80% of it, frankly. Obviously, the deal and the demographics all have to make sense. But people can make the numbers, and they could spend things any way they want to. And having worked on Wall Street, been around a lot of guys that were really ethical, and been around guys that weren't. So for me, it's investing in picking the right jockeys.
Mm-hmm.
Yeah, I was gonna ask you a question that was not on the questionnaire, but you already answered. Like, how much importance would you give to the sponsor versus the property? Like you already said, a sponsor is a pretty big number in there, right?
Yeah, for sure. It's a big number.
Okay. Okay.
That's why I invested with you,
Now,
Martin.
thank you.
You.
And Claudia.
So,
You.
for someone that's starting out, all these people we meet in these meetups or in these events, the first time they hear about multifamily and they come to you and they ask you what would be your best advice for that people starting out looking for their first passive investment? What would be your best advice?
Ask a lot of questions. And think like, try to Google around, listen as much as possible. Try to ask really intelligent questions. There's something that I always think about is the phrase "ask better questions." So figure out, what is the question? What are you trying to understand, and how can you ask the best question to understand that? So that's and frankly, if you ask a question and that person doesn't want to respond, or responds poorly, then kind of the investment decision's made, right? You shouldn't invest. So if anybody makes you feel dumb for asking a question, like, you shouldn't invest, because it's not going to get better through the life of the transaction.
True.
Yeah.
There's not such a dumb question here.
Yeah, there's for sure.
Yeah.
And so, in terms of asking the question, so when you are you trying to, and especially in the beginning for someone starting now, were you trying to analyze the underwriting? I mean, did you have do you have any techniques that you're looking for in their underwriting, or are you pretty much just, I mean, you may say 80% is the sponsor, but do you feel like you do any analysis, any comparisons, or anything that you do from an underwriting perspective?
This year was a little bit about, needing to move quickly, and, we were also trying to pursue our own deals. So I was spending, 99% of the time, investing in our own opportunities and chasing our own opportunities, and, less time, sussing out the passive opportunities. And that may sound funny, but when time is limited, you really have to say what sponsors, and just look quickly at the decks. And a lot of it is median income, is have in the decks, have they thought about the right things, whether that's downside risk, whether that's showing rental comps. It's bizarre that you look at decks and they don't have rental comps in there. And that's the whole story, right? Is we were touring some properties today. And then, you go see the rental comps, and like one of the comps, like the rents were, I don't know what the story is. It's a not-for-profit, but the rents were half of what they were at this existing property. So it's like, how you have to understand the competitive landscape. So if sponsors don't include that, that's kind of a red flag. One deck that I looked at, it took me hours to figure out, this was early on too. So I was like looking through their PPM and just trying to figure out what the fees were and why their closing costs. I think the closing costs, which is going to sound crazy to everybody here, were 13%. I was like, I don't understand this. Why is it 13%? And they were just taking all these different fees and so forth. And it was just insane. And so, it was a smaller deal, but, still, it just wasn't clearly disclosed. And for me, I come from a background where, disclosure and compliance is really key. So if you give the sense that you're misleading somebody, you get fired. And so, for me, it's really important that a deck is really clear, that, when you're talking with people or asking them questions, they're giving you straight answers. And that is, just something important that I look for, in terms of, looking at, I guess there's a ton of things that I look at now, but, how is income growing? What is economic vacancy assumptions? What is the normalized cap rate going into a deal, adjusted for property taxes, normalized for expenses? What's the price per door? And, are they getting it at a good basis? Where is that trade versus other trades in that submarket? Sales comps is important. I think that's something that people don't really, highlight. But that's important. Other income, you see some people, just having crazy other income growth. And to me, it's like, how real is that? I think that's one way that people try to cheat. And then I just ask, where has that been tested, and where has that been proven? And, why do you think you can do that? expenses, obviously taxes and insurance. Insurance is something where, there's, people are still, underwriting too aggressively. I know a deal that, I think is closing real soon where, I talked with their insurance guy and he said, yeah, that insurance cost that they had is going to be, up materially. So, just because they were just underwriting too aggressive and, we know deals that have fallen apart for insurance reasons. So, just want to be sensitive to that. Also on the debt side, what are proceeds and what are rates and, have they thought about that? As well as property taxes, are they underwriting to the right amounts? Try to look at all that stuff quickly, but if they're not being forthcoming and spelling a lot of those things out, then, it's just kind of like, if it's too much brain damage, then I'm just like, forget it. They should have done this homework. I shouldn't have to do it. They're trying to, ask for my money. They should at least have spent the time that is necessary to do that. So I'm pretty particular about, I guess my own decks and, how I pitch things. So I kind of expect the same if I'm going to invest with people.
So on the expense side, I mean, you mentioned, you gave an example on the security guard there, but have you seen any red flags? Do you look for any red flags when someone's portraying that they're going to have this huge reduction of expenses?
Yeah, and like one of the second or third deals I passively invested in, again, purposely passive. I really liked the sponsors. I believed in what they were doing. They're doing a lot of partnerships with local churches. But one thing that was really bizarre was their expenses were dropping. This is going to sound crazy, but from the T12 to year one, it was dropping 20%. And I'm like, how is that possible? Mm-hmm. And, they were just saying that, it was going to be managed by Wayner. And I said, well, have you, what has your experience been with them? They're like, oh, they manage our other asset. Are they really hitting those expense numbers? And I said, yes. And then, when you started learning about Wayner and everyone, knows them as having a reputation for running things lean and cheap. And then you realize, wow, maybe that's real. So, I wanted to see if that played out. And so I invested in that deal and, that turned out to be, good given where, similar deals have traded after that. So, glad I did that one.
So they end up being able to reduce expenses by 20%?
Yeah, I mean, well, that's what they had underwritten. It's still early on. I don't ask many questions of these people in the first few months because I know from, my own experience, it takes some time to just get, the business plan implemented. There's a lot of noise with, is this CapEx? Is this R&M? So kind of give people a little bit of grace. So we'll see.
And on the revenue side, on the other income, how do you look at it? Or
one thing is seeing a breakdown. So some people will just, not show a breakdown of that. And I think that's silly, right? I mean, that's a big driver because, usually that other income might not have any expenses associated with it. And so it's just directly going to NOI. And that is directly, going to boost your exit sale price, right? And so, I just like to see, what are the assumptions there? Why do they think they can get it? Just any kind of key component that is going to drive value. I want to understand it, and I want to understand why they think that that's possible.
So now that you've invested, the first deal was a while ago. Is there anything that you would wish you could have done different or better? Any regrets or things that you will?
I think we always learn a lot. And now how I look at deals is just, way different than how I looked at deals when I first got into the space. You just, you're able to ask kind of what I was saying, asking better questions. I feel, that's come a long way for me personally. I think there's some sponsors that I probably wouldn't invest with again. I think another thing, just, whether a tip for, or just, a red flag for me is if I, most people, I just, I'm not asking for the T12 rent roll and OM just because I frankly just don't have the time to, underwrite something that is just for a passive investment, at least this year. And so, but if I did ask somebody for it and, they were like, oh, ask the broker. And I was like,
Oh, really?
Yeah. So I mean, exactly. So, from that perspective, that's kind of just a big X for me. It's like, no, thanks. That's not something that, interested in. So, and people that are, if you can't get that type of information, what is it going to be like? If this is a 5-year hold, let's say, if they're not willing to do that for you up front, then, and people, if they can't be transparent, then, there's a problem. And again, if it's purposefully passive, I think that, everyone that invests with me or I invest with, like, I'll probably have questions about things, and I hope that they would say, hey, you've invested with me and I'll be gracious, just like Martine and Claudia. Hopefully you're gracious with me for being so late today. So.
No, that's the reason why we invited you, because we know you're thorough on your analysis as a passive investor, and you really ask good questions, and you think about things that usually as a passive investor they or us at least when we started, we were not thinking about. So we wanted to bring that experience here that you have, and that kind of eye you have, trained eye to look at the deals.
Sure. And I'm happy to put together just some questions. I was thinking about, sometimes there's so many questions to ask, and, each deal deck is different. So you have to figure out, like, did they have this? Did they not? And just try to find, if there's any things that you're missing. But I'm happy to put together a list of questions if, any listeners or people are interested in that.
Awesome. Good.
I think a good follow-up question on that is, you had a really great financial background. So you were halfway there. For people that's coming in from, I don't know, ophthalmologist background or dentist or maybe not engineering or CPA that are coming here, how important do you think it's education just for passive investors? Because I know there's a lot of education programs out there for sponsoring, but do you think that that's something that everyone, or at least someone who doesn't have a technical background related to numbers would need?
Yeah, I think, two things. I think one, people should. I think people need to understand that, I've been around markets my whole career, right? So I understand when things are great, and I can understand when things go south really fast. Like, I've lived through, the financial crisis. I worked on Wall Street during that time. I worked on, seeing CEOs of large investment banks saying that everything is good here, and then the next day, they were declaring bankruptcy. Like, I've seen that. I could see when liquidity goes to zero real quick, and people run into issues. So, I think it's really important that people understand, these are liquid investments. These are things that are underwritten to 5-year hold. If we have any type of slowdown over the next 5 years, it may be a longer hold. I know, in one of our deals, we put 10-year debt on. And so that just buys us some time in case there is a slowdown in the next few years, right? So, one, with that mindset, people need to really understand what they're getting into. So some type of, friend, if you will. Like, I think there's a few ways to get educated. Like, today I drove a friend, to San Antonio with me because he's interested in multifamily, and so that he could see kind of the questions I'm asking, the things I'm looking at when we're touring properties. Just as a way to help him out. There's a lot of different, trainings out there. He even actually said the Udemy courses were really good for multifamily. I think there's probably, I think some of the stuff by Neil Bawa, I'm always, that is, I like that type of style, deep analysis and, really creative approach to problem solving. But yeah, any way that before making an investment, for me, I think it was a little bit different because, I needed to move quickly. I had, a fair amount of capital I need to invest. So, a $25,000 investment, is not going to sink, my portfolio. And I'll just say, for other folks that, that whatever amount, if it's meaningful, they should just make sure they understand all the risks and they're able to make a competent decision on whether they should, invest or not. And they should ask friends, ask sponsors. I think it's helpful. I know that, Martine and Claudia, we've been, pretty candid with each other about, different sponsors that we've seen in activity. And I think that's helpful. I think it's it's not, talking behind people's back. I think, these are real dollar investments, and people can make and lose money. And, this is their families that they're trying to support and their livelihoods. I think people should, be able to talk freely and, without feeling like they're slandering somebody.
Yep.
Just present the facts, right? I think that helps all of us make better decisions.
True.
Yeah, absolutely. So are you doing real estate full time now? Is that your full time career?
Yes, I am.
Awesome. And so just talking about, since, you have a good background you mentioned in terms of the market and financing and everything. And so, there's a lot of noise in the industry now about a potential downturn, and is that going to happen in 2020, 2021? Do you, when you're from a passive investor perspective, do you, are there anything that you look into the deal in terms of preparing for the downturn? Do you look at the debt that they're using, the IO, the ratio that they're getting? Talk to us about how do you think you're preparing yourself and the passive investors should prepare themselves for a potential downturn, what they should be looking at deals?
Yeah, I think, one deal I looked at this morning or late last night, they had 3% rent growth across the board and, aggressive exit caps. And, I think the exit cap particularly is, if you want to be aggressive with rent growth, then be conservative on exit cap. If you want to be conservative on rent growth, then okay, you can be a little bit more conservative on the exit cap. But I think that's something, in terms of a potential slowdown, and, it's going to happen, right? Like in the next 10 years, for sure, something, the Dow can't, or the stock markets can't continue at this pace, right? So there's going to be some type of stumble. And, the exit cap often, provides that cushion, particularly if it's conservative, that, there could be, a slowdown, and, that's kind of accounted for in the exit cap. I think, on the financing side, at first, personally, I was opposed to bridge loans. We're actually, bidding on an asset with a bridge loan. It's just for some assets, that's the right thing. Like for this asset, we're going to try and sell it in 2 to 3 years. So, from that perspective, it doesn't make sense to put 10-year debt on an asset that you're going to sell in 2 to 3 years, right? Because you should always match your liabilities with the asset, right? I guess in other things preparing, if people are buying at a really high price per door, it's just kind of like, yeah, that seems kind of rich, why do that now? Is there better? I always think like relative value. If you're going to spend, 100 per door in, some tertiary market, like why not buy in Irving at 100 a door? I just feel like that would be a safer bet in a downturn. I also look for, if you look at historical vacancy for 1-bedroom properties, they tend to be a lot higher and spikier. So, I always feel better around 2-bedroom plus properties if there's a higher percentage there. So that's kind of one thing where I feel like it's harder for families to move. It's easier for, a single guy that's a construction worker to go to a different place and, just skip out on rent. Those are the things I guess I think of, in terms of a downturn. And, if it's like a high occupancy, high cash flowing asset, I would hope that they wouldn't put a bridge on it. Like, why put a bridge? Just put agency debt, and, maybe if you have 7-10-year debt on it, then you can ride out a storm. The IO component, you hope that, they don't have a false sense of security that they're 4 years IO or 3 years IO, and year 4 comes or year 5, and, they didn't account for, the principal payments that they have to make. So hopefully they're, astute enough. And I think that's where you're betting on the operator, that they haven't distributed all the cash, and, here comes a principal payment, and they, kind of, stutter with that. So that's kind of some of the things that I guess I think about in terms of, a downturn. And, just being in good locations, good markets, or, where there's a story that, hey, this is a path of progress. If it's a tertiary market, I just get a little bit concerned about those things.
You mentioned the path of progress a couple of times. Do you use any particular tool to verify that or validate that when a sponsor is telling you, hey, this is on the path of progress, and do you use anything that you can validate it?
You know, I guess you just try to, I guess that's more of a qualitative thing, right? You know, you look at, you know, I guess quantitatively you could see where other assets have traded. You could see, you know, has there been, you know, less crime in an area? Has it, when you go there, I think it's a qualitative thing. You know, I kind of have this child test, like I have 2 kids. So do I feel that I could take them there? And if I can't, then it's like, yeah, maybe I shouldn't invest or buy this asset. You know, I think safety is really important for, you know, good tenancy and so forth. So I think, you know, path of progress is probably a little bit more qualitative. Obviously you want to see, you know, kind of revitalization or new things happening, investment in that area, whether that's hotels or businesses or so forth. So that's a little bit more on the qualitative side, I guess, than a quantitative measurement. But you know, if there's population growth, if the median incomes and vacancy has all, you know, been tight, I think that all kind of quantitatively tells that story.
Is there a particular medium income that you look to, that you would avoid or that you focus on?
You know, I think that the median income, I'm a little bit, you know, maybe this is a little bit different, but I look at the rent roll and I figure out, you know, are these people really paying the rents that they're saying? I mean, we bid on an asset in Houston where the median income was less than 30,000, and that might shock some people that, you know, why would you bid on something? But these people were, you know, seemingly paying, you know, the rents, and, you know, they were staying there for a long period of time, and, you know, it showed a positive trend in terms of the rents that they were paying. So, you know, that gave me comfort, that overrode, you know, sub, you know, 29,000 median income or whatever it was. You know, I guess also, you know, particularly I think about Houston or any of these Texas areas, you know, people may work, you know, a little bit further away, but come to live at a place that is enjoyable. So the median income may be a little bit different than, you know, might not tell the full picture. So, and who knows how old that data is anyway, but you know, I know other people look at it, so you have to be sensitive to it and you have to understand it. But, you know, I probably wouldn't make, you know, massive bets on you know, areas that, you know, had a poor mix of median income and a poor mix of, you know, demographics and tenant base and so forth.
Got it. So do you have any like for someone starting as a passive investor, do you have any book or podcast or tool system that you would recommend them using?
You know, I think the you know, the Whitney Sewell podcast, Old Capital podcast have been, you know, pretty informative. Those are the two when I drive to Dallas. Those are the two that I like to listen to.
Can you repeat the first one? It kind of broke up for a second.
Yeah, sorry. The Old Capital or Whitney Sewell podcast.
Okay.
The syndication, the real estate syndication show. And then in terms of books, I mean, I know Joe Ferris, I can't say that I finished that book, but there was a good YouTube video when I was starting into the space about a guy that built a multifamily model from scratch. So, you know, if you're trying to understand modeling, that's a good video. And I've met with that gentleman. He's a super standout guy. He's a professional. And then, you know, the education courses, I think, you know, if there's a home study course or something that you can dip the toe in before, you know, paying up for a mentoring program, that's probably the smart approach if you have that time. You know, I think Neil Bawa, you know, I think he does a really solid job in terms of, you know, a lot of free content. And, you know, I would just say there's so much out there that, you know, I'm always a believer if people really want to learn something, they'll figure out how to do it, you know, dedicate the time and resources to, you know, find, you know, whether YouTube channels or podcasts that, you know, can help them in that regard. And then talk with people. I think, you know, I know that Martine and Claudia came over when I was, just wanted to pick their brains on how they look at things. And they showed me a lot of tools that were really helpful and that I use. So I think, if you do that with a number of people and you do it in a constructive way where you're trying to help them as well, that's a great way to learn. Like I try to do with my friend, just spending, 6 hours in the car today, just, letting him ask questions about, how we underwrite or, how we think about things. So just always more to learn for sure. And there's always, people that have a lot of experience or have been through things that, you learn a lot from people's mistakes. And it's not to, shame anybody, but, it's just, I think, I had lunch with someone today that, had a lot of bumps and bruises and had to replace piping and plumbing in his property and, had a gas line explode and, crazy things, but, sold the asset in 2-3 years and doubled people's money. So it's just amazing how you can, drop the football and fumble and, feel like you're losing the game, but, win war. So that's pretty encouraging for folks.
Yeah, absolutely. So we want to open up for questions to see if anybody participating have any questions you want to ask.
I want to know what the 10-year Treasury is going to do in the next 2 weeks.
I think my view on Treasury is just lower. I think that just given that yields around the world are, people are always hunting and searching for yield. I think that just puts a lot of, like I say, whether it's artificial demand or, people just saying, hey, flight to safety, or they can get yield. And would you rather invest in European countries that really have no economic growth, or get negative yields, or would you rather invest in the US where there's, I think something that's so unique and it, given that, there's a number of people on this that are from different countries. I mean, the reason people come to the US, and my father is from India, is just because there's a lot of economic opportunity here and a lot of growth potential. And, I think people will continue to invest in this economy because, that's just the DNA of America is freedom of capital and freedom of, thought. So, which, is kind of unparalleled in the rest of the world. So my long-term view is treasuries will continue to stay tight. And I think that's what makes multifamily, I kind of look at exit cap rates and say, from a relative value perspective, where you're going to earn, even if you say, a 6.5 exit cap is aggressive. Well, where are you going to earn 6.5% on a high occupancy, asset?
Mm-hmm. Okay. So
If you
Louis, Clayton, Georgia, Elliot, any questions for Ryan? Clayton, you always ask really good questions. So you have to step up this time.
Yeah, guys, and I'm so sorry for I won't give you any excuses, but just really apologize for starting so late today. Sorry to keep everybody waiting.
You made it up with great content.
Oh, thanks, Claudia. You're so gracious. Yeah.
It's amazing to have you. I mean, when we are in the meetups, we can have this quality time.
Yeah.
I have a question on the exit cap rate, because I think it's tricky to foresee what's going to happen in the future. So how do you measure an aggressive or a conservative exit cap rate?
Yeah, I mean, typically, what I look at is, okay, what are they buying in at, on a normalized tax rate adjusted, purchase cap rate. And then I say, what I see professionals doing is, 10 basis points a year, which I feel like is a little bit of, that's okay, for professionals. I think it's a little bit aggressive for, people that just have, first time syndicators or a few deals under their belt. So that's kind of where, I kind of say, hey, that's kind of aggressive, just given their experience or so forth, or given, the asset, the demographics and the like, or what they paid, they might not get that back. So that's kind of how I view it. And then I just think about, well, this other deal that I may have invested in or know about, what did they use and why is this particular person using something so much more aggressive? And, whether that's for an asset that's way older and could have, different issues or the like.
Thank you. That's a good.
Yeah.
And for me, it's also like relative value. It's thinking about, okay, what is it in an area that I know and like in Dallas, and what is it in a, whether it's a rougher area in Houston or, a tertiary market. It's like, that doesn't make any sense that, we would use a 7.5 in, an area like Irving, but use something way tighter in some tertiary market. Like that trade doesn't make sense to me. You can't have only a flat spread versus DFW, where there's such a great growth story, and tertiary market where it's kind of, whether heavily oil dependent or heavily one type of business segment dependent. I just think in terms of relative value, like those things have to make sense to me.
Yeah, absolutely.
Awesome.
All right. So if nobody else has any questions, I just want to remind everybody that we'll meet again on the first Wednesday, so which is going to be December 4th, and we focus that meeting on getting our first syndication, and then we'll meet on the third Wednesday of December, and that's repeating every month. And the third Wednesday is December 18, where we're going to again focus on passive investment.
Thank you for watching this week's episode of the Multifamily 0 to 1. Join us live the first and third Wednesday of every month.